Hello and welcome to the latest Insider interview. Our guest today is Gordon Lowson, who is Global Head of Liquidity at Aberdeen, where his team manage the Aberdeen Sterling Money Market Fund. Gordon, thanks very much for coming into the studio.
Thank you for having me.
Money market funds are cash-like instruments, but what value do you add as an active fund manager versus just leaving your money invested in a bank deposit account?
So if it's compared directly to a bank account, these funds outperform bank accounts in pretty much all circumstances. The reason for that is because typically a bank account would be instant access, and because of that it would be very closely linked to the overnight rate. That overnight rate, there would probably be some form of margin in there or fee in there for the bank as well. Whereas with a liquidity fund, because we can put our WAM out to, for example, in this fund, up to 180 days, we can go further along the curve and we can eke more value for that. We can buy things, for example, like the floating rate product that I mentioned earlier, where you get a pickup over the overnight rate. So they're normally linked to SONIA, which is the overnight rate, which would be. So basically, it's just because it's a pooled vehicle, you can just take slightly more risk, go slightly out the curve, and outperform a bank account. The other key thing to remember as well is that if you have your money in a bank account, you have a single name risk with that bank, whereas we're investing in a portfolio of high quality banks. So your credit profile is significantly better in a liquidity fund. And in actual fact, some short-term liquidity funds, in fact, most short-term liquidity funds are actually AAA rated by rating agencies to reflect the strength of the credit within the portfolio.
So how many banks are you spreading the risk across then typically?
So we would, on our active names that we use on our credit list would probably be about 120 banks. In the portfolio at any one time, maybe 60 names, something of that nature. So it varies time to time, but that would be typical.
And what levers can you pull to increase returns during a rising interest rate environment and a falling interest rate environment?
So typically, behaviour would be, in a rate rising environment, you would shorten your WAM so you could get the pickup of rates as they go up, and you're not waiting.
WAM being weighted average maturity.
Weighted average, yes, absolutely. So you're not waiting for the fund to reset at the higher level, it's resetting quicker. And vice versa, in a rate cutting environment, you would typically lengthen your WAM to keep those longer rates in the portfolio for longer. However, if you think there are too many hikes or too many cuts priced in, that might not work as well, if you like. So another way of removing that risk is to buy some floating product, which we've done recently, and just basically crystallising that pickup over the short term rates. What we've been doing recently in the fund, as there's been a bit of volatility with, markets are volatile just now, the outlook, given all the trade tariff, trade war stuff is going on, has meant the outlook for interest rates has moved about a bit in the last while. So what we've been doing is just opportunistically, when we've seen rates spike up, buying some longer dated assets and just holding it, and when coming down, doing a bit more short dated and a bit more of the floating stuff.
And this active approach means you can typically outperform what a bank offers and actually outperform what the central bank or the Bank of England interest rate is.
Yeah, in almost all circumstances. Yeah.
What are the risks associated with money market funds?
Well, they're very low risk. I mean, I think it's important to understand that. The risk is, I guess, credit risk. We have exposure to banks. But again, if you were comparing it to other places you might put your cash, it's a much stronger credit profile than that. And we have, sitting behind it, we have our credit process, which I talked to earlier, which mitigates that risk to some degree. There's a small amount of interest rate risk, but the impact of that interest rate risk is really on performance a handful of basis points. It's not capital loss type risk. It's just more kind of, you might underperform your peers by 5 or 6 basis points maybe, but it's not a real risk to capital. So, to my mind, these funds are as close to risk-free as there is. Gilts or government debts often describes the risk-free asset, but as you know, if you're buying a long-term gilts, you can lose capital if the curve changes and all the rest of it. Whereas with these funds, they're designed to preserve capital. So, they are very, very low risk.
The Bank of England has warned on liquidity during market events. So is that a real risk? And what's been happening recently? We've just gone through Trump's tariff announcements where equity markets have fallen a lot.
What I would say is any kind of most public commentary around money market funds are really focused on short-term money market funds. So those short-term money market funds I described earlier are overwhelmingly the biggest part of the market in Europe. I think within the International Money Market Fund Association universe, there's about 800 billion, I think, roughly just now in these money market funds. And these are the ones that we have see corporates going in and out, and we see, and there's much more volatility. So they tend to be where the focus is, not these kind of pension type, ISA type funds that we're talking about today. And the concern is when there's market turmoil, is there sufficient liquidity in these funds? Now, I've been in the market for 30 years, and I've worked in money market funds for 25 of those 30 years. So I've gone through the financial crisis and various other crises, and these funds have typically behaved well through all of that. During COVID and Liz Truss budget, when we saw a lot of volatility, these funds delivered their investment objectives. There were funds in 2008 during the financial crash called enhanced money market funds that had much more risk. So in comparison to the weighted average maturity of the funds we were talking about, they might have had a weighted average maturity of 2 years or whatever, and they were buying more credit and they were buying more asset-backed type credit. And a lot of those funds suffered during that time. And as a result of that, there was quite a lot of regulation over the last decade on these money market funds to make them hold more liquidity. So I think some of the concerns that are sometimes expressed in the press and sometimes from regulators or central banks, I think are overstated. I think these funds perform well in difficult circumstances. And often the mistake that people make when they look at these funds is they think in terms of market stress, how would you cope with outflow? Well, the reality is, in terms of market stress, people go into cash. They're not taking it out of cash. So I think people sometimes lose sight of that the reality of that, so to my mind, these funds are safe havens in times of market stress, as opposed to a systemic risk.
And during the past week or so, we've seen Trump announce tariffs, equity markets down 20-25% in some cases. The money market funds, however, have just kept ticking up
there's no
in value.
I mean, you wouldn't even know anything's going on, really, to be honest. I think sometimes in the States, it's much more obvious in the States when risk on and risk off. You see money going into money market funds and then coming out. But I think because the overwhelming majority of investors in these money market funds are in the short-term money market funds and are often corporates, it's not investment style behaviour, it's more corporate type behaviour, so it's different. So we don't see that to the same degree. So we've, our funds are, you wouldn't know there was anything going on in the world.
One of the hidden risks with investing in cash-like products is inflation. So what is your answer to the inflation risk that cash presents?
Yes, so there's not really anything you can do within the fund to address that. Given that central banks' primary tool for controlling inflation is central bank interest rates, and the fact that these funds closely follow central bank interest rates, basically it's the central banks that do that inflation control for us, because we're so closely linked to where the official rates are. So we can't do much ourselves whilst managing in the fund, but if the market's working efficiently, the central bank should be doing that and managing that inflation risk for us.
And why choose a money market fund over a bond fund?
It's really just the fact that it's back to the preservation of capital point. The risk is so low within liquidity funds. There's a real predictability about return in these funds, and if you can predict the future of interest rates, you're going to pretty closely predict your return. Because the risk of capital loss is so low, they're very, very steady. Now, you reduce risk in going into a short-term bond fund, but you still could lose capital, you still have more risk, you still have more volatility than you would within a liquidity fund. So it's basically just a spectrum, really, of risk, you know, and you have equities at one end, and you have, you know, bonds, government bonds closer to the other end, and in cash is the extreme other end. You know, so it's just basically just moving on that spectrum. So, yeah, short duration bond funds can be a defensive play, but this is an even more defensive play.
And in the short dated bond fund, if interest rates are falling, you might see some capital uplift there. But in a money market fund, you wouldn't get that to the same extent.
No, you wouldn't. No. You know, no.
How is the income distributed in your fund? Can it be paid out or is it reinvested?
So it can accumulate, an accumulation fund, so it accumulates into the price, or it can be distributed as income on a quarterly basis.
And finally, the question we ask all of our guests, do you personally invest in your fund?
Thankfully I do. Given the market turmoil we're seeing at the moment, I'm glad to be in the fund, and I wish, to be honest, I had more of my portfolio in it.
Gordon, thanks very much for coming into the studio.
Thank you.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment and subscribe. See you next time.